Hello, it's Mark again from Landmark Financial Services Group. This is the third video in the series on equity compensation. Today we're going to talk about two tax strategies, one for restricted stock and one for incentive stock options or ISOs. Let's talk about the restricted stock. Let's revisit how that works. You're granted some shares and then you vest in them over time. And every time you vest, it becomes ordinary income to you. When you have a rising stock price, every time you vest, more and more of the appreciation becomes ordinary income. Okay? So wouldn't it be cool if we could start here, and instead of every year taking more ordinary income, let's say we were to establish a floor of ordinary income and all the rest becomes capital gain. Okay? By doing that, you could pretty much cut your taxes in half. Now that's pretty cool, but there are some perils to it. Now, this strategy is called an 83B election. It is an election that must be made within 30 days of getting the grant from your company. It's an election, it's a piece of paper that you fill out with the necessary information, and it's filed with the Internal Revenue Service within 30 days. So whatever happens during the year, you got to file it right away. So you can't stall on something like this. There are some perils to it. Number one, if the stock price actually goes down, this strategy works a little bit against you instead of for you. And if you're going to terminate, or if you think you might not last through the vesting time, let's say it's a 4-year vest and you think, I may only work for this company for 2 more years, this is not a strategy that will work for you. So we can talk more about it when you call because there's a lot to it. But anyway, that's the essential part. The second one is incentive stock option. In the last video, I just touched on this notion of alternative minimum tax. And unfortunately, with incentive stock options, even though the date you exercise, there's no taxable income on the regular tax system, there is on the alternative minimum tax system, which means you could end up paying quite a bit of alternative minimum tax in year one. So what do? We have what we call a laddering system where you might pay and exercise some incentive stock options in year one and pay the tax, okay? And then in year two, and you hold the shares, by the way, you keep the shares, you don't sell them. In year two, you do it again. You exercise the options that you, on the next set of vesting, and you sell the shares that you bought last year. And what that does is it creates a positive AMT adjustment on this year's exercise and a negative AMT adjustment for the shares that you sold and bought from last year. And those two, if you do it right, can offset each other and eliminate your AMT tax. And you can keep that going right up as many years as you want to go. And that strategy does work. And of course, the goal is to try to take as much of these shares and turn the gain into capital gain, not ordinary income. And by doing that, we cut the tax in half. Again, there's perils to this, which we can talk about if you call. So that's just a really quick glimpse of a couple of strategies that we have. If you want more details, always call me, 978-984-5425, or you can look me up on the web at lmfsg.com. Okay, thanks.